Hello students. Now we are going to discuss about the concept called arbitrage in financial management. How to handle the arbitrage, when it will arise, what are the concept behind arbitrage. That is what we are going to learn. First I will explain the concept. Thereafter we can go for practical problems on arbitrage. Arbitrage. What is called arbitrage? It refers to buying assets or securities at a lower price in one market. It refers to buying assets or securities at low price in one market, and at the same time selling it at a higher price in another market. So selling it at a higher price in another market. So buying it from one market, selling it from another market. That concept is called what? Arbitrage. As a result, if I'm going to buy and sell, equilibrium is obtained in different market. It attained equilibrium in different markets, so that we can be the position to balance the price. Investor of the firm, in case of shares and securities and all, investor of the firm whose value is higher, shares value is high, will sell the share and buy the shares of the firm whose value is lower. I am having share, my company share price is high, then as an investor what I will do? I will sell the share, and that sales profit I am going to invest in new company. Another company is what? Share. That share value will be less. So buying the high value, selling the high value shares and buying the low value shares, and I want to maintain the same return, or I may going to get what? Excess value. The sense what? My cash outflow will be less, but I am going to get the same return. Are you able to follow or not? That concept is based on arbitrage, that is based on approach. Investor of the firm based on approach, Modic-Lander-Miller approach. Okay, investor of the firm represent company. Okay, investor of the firm whose value is higher, whose value is higher. What they'll do? Will sell their shares. Will sell their shares, and they'll buy the shares of the firm whose value is low. High value firms shares we are going to sell, and low value firms shares we are going to buy. That is what you are going to say. Okay, and there will be able to earn same return at low outlay. So we'll get what? Same return at lower outlay. our cash outflow will be less, nothing but investment will be less, but we can get the same return. That particular concept is called what? Arbitrage. Now, if I give a small example, you can able to have the grip over the concept. Assume market A and market B. Okay. Product price of the product in market A, assume 4 rupees, and market B, it is 14 rupees for the same product. Then what you will do, as an investor, what you will do, investor's decision. You will buy the product from market A and you will sell the same product in market B. So that 4 rupees you will invest and you will sell 14 rupees, so that you can gain what? 10 rupees is a profit for you. So as an investor, we are going to buy it from lower value and sell it in the higher value. Clear? Then what could be the impact? Hence, in market A, demand of the product will get increase. In market B, keep on we are selling. Therefore, supply will get increase. One hand, demand will get increase. Another hand, supply will get increase. Therefore, what will happen with respect to selling price? Impact with respect to selling price. Demand increase in market A. Therefore, selling price will get increase. Supply got increase in market B. Therefore, selling price will decrease. So 14 rupees keep on, it's going to the decremental trend. 4 rupees keep on going to be incremental trend. One particular point of time, both the market will have the same price. This is because of what? The concept of arbitrage and the equilibrium concept. So, arbitrage is happening because of imperfect information. This is happened because of what? Imperfect information. We don't know what is the price of the product A and for market A and market B. There is a gap. That's the reason what? Imperfect information. So they are not in the position to sellers or what the industry not in the position to fix the same price. That's the reason concept again arbitrage. And arbitrage is a riskless profit. They're selling the same product only. Therefore, there is no any risk at all. Riskless profit. But due to modern technology, arbitrage opportunity will reduce. Opportunity with respect to arbitrage process got reduced because of what? Modern technology. Today we can be the person to identify what is the price of the place A, market X and market Y. Therefore, directly we can buy through online. Therefore, the concept again arbitrage keep on reduce. So, what and all you have to learn with respect to arbitrage? Theory point of view, arbitrage refers to buying the assets or securities at a lower price in one market and selling at a higher price in another market. As a result, equilibrium will attain in different markets. Now we are going to discuss a general theory with respect to arbitrage. Based on approach, Robert costing FM paper, capital structure theory. Approach is the modular approach. Based on that, investors, as an investor, I am having the shares. I will sell high value firm shares so that I am going to get X amount of income. And I am going to buy low value firms shares so that my cash outflow will be less, cash inflow will be more. And I am going to maintain the same return. Therefore, with a lower outlay, cash outlay, I can maintain the same return. I can get the same return. That concept is called here arbitrage. Investor of the firm whose value is higher will sell the shares and instead buy the shares of the firms whose value is lower. They will be able to earn the same return at a lower outlay. For that only I have given some example. Now, shall we do some problem based on arbitrage, which is relevant for our examination?